Hey everyone, welcome to the KE Report, another daily editorial, this time focused on the energy sector, oil and natural gas, as I am chatting with Josef Schachter, founder and editor of the Schachter Energy Report. Also writes the Ion Energy Report. That is a free report that breaks down just the fundamentals, the data around oil and natural gas. The Schachter Energy Report, that's where Josef gets into the individual stocks that he is following. Josef, let's start off with a quick overview of the natural gas market. Natural gas prices generally higher, really at the highest level that we have seen all year in pretty much 2 years. Not really breaking out to anything historic, but in around that 350 range. Look, this is coming seasonally with colder weather. Is there anything else at play here, Josef, that could lead to a more sustainable uptrend or another leg higher in the natural gas price?
Yeah, there's a number of reasons. Number one, you talk about winter, and the draw that came out this morning from the EIA was 125 BCF drawdown. So we're now only 0.6% above a year ago, 3.8 above the 5-year average. Last week we had a very nice drawdown of 190 BCF. So the cold weather is helping. And so I think as we get into 200 BCF drawdowns for a couple of weeks in a row, I think we can punch through $4, which I think is possible. And I think that would really wake everybody up to what's going on down south. And as you may have read in my Ion Energy, the Pascualis new facility which was brought on in the last week is now shipping. So that's an extra 2.5 BCF per day. So that's an incremental export for LNG. And LNG exports are now at record highs in the United States. They are the largest exporter of LNG. And again, here in Canada, things are not as nice. We're still waiting for LNG Canada to start up in Q2 of 2025. And of course, the price of natural gas here is $1.80, $1.90 for AECO. So those companies that are selling into the US Gulf Coast or into Dawn are doing okay. Those that are in the Station 2 AECO market are not getting good pricing. And so that's why we saw during the Q3 results of companies that those which were natural gas focused that had access only to Western Canada had very disappointing results comparison to a year ago. Maybe, depending upon if you had hedges, you're getting maybe half or even a quarter of what you were getting a year ago, depending upon your hedge book. So, and those with no hedge book really had a tough time. So, we need to see the Canadian price pick up. We've probably got one more quarter of sloppy prices, the fourth quarter. And then in Q1, winter pricing, January, February can be very strong. And then, of course, Q2, we have LNG Canada. So I'm very optimistic. A lot of the stocks are being hit pretty hard here. Tax loss selling is very painful right now. We're at 52-week lows. There's bargains galore everywhere. We're expecting another buy signal. If you remember, on September 10th, we had a buy signal. We added 5 new names, and that worked out very well. I expect that between now and December 30th, which is the end of tax loss selling for 2024, that we will probably get another buy signal that's imminent, and we will be adding additional names on the buy side, both for oil, natural gas, and I think that's going to be the low for the year, and we'll set up for a very nice 2025. And I'm very optimistic on 25. As you know, I was cautious from Q2 of 24 because I saw the data coming out that the US comparisons were below the prior year, so weak demand in the US. And then, of course, China, the big data started beginning to show up for there. And I said at the time when we were in mid 80s, we were going to go below 70. That had, as you know, occurred. And we got down to $66 on September 10th. We rallied since then. We're about 70, 71 now. I think we're going back down to test that low in the coming weeks. It may even drag into January, and that will then give us another great buy opportunity. And I expect we'll send out some more buy recommendations. But I think Q1 is probably going to be, let's say high 60s to high 70s. Q2 maybe mid 70s to low 80s. But in Q3, I think we start seeing 80s on a regular basis. And then in Q4 of 2025, I'm looking for $90 on a regular basis. And that's why I'm very bullish, because I think supply and demand starts improving in Q2 And then once we get into the summer of 2025, I think people will realize that there's a shortage and then OPEC can bring on more production, but they'll only do it if they can get the right price.
Joseph, how do you view that whole shortage narrative or just strictly the inventory narrative when it comes to oil and natural gas right now? Are we in a deficit? Is it concerning? Or is the market oversupplied?
Well, you've got to look at it from the point of view of two things. One, global, and on a global basis, we might be oversupplied because of China has been buying and putting it into the strategic reserve. Final demand is not there. So you could say there's a surplus, and China's soaking it up to because they think these prices are cheap and they think in 2025, and they're fabulous commodity speculators. So they're probably looking for much higher prices in 2025. But if you look at the domestic US side, inventories are very low. And so we're looking at the potential for, if the US economy starts showing the growth that we think it can once Trump's in office and they start doing a lot of the things they're talking about to get the economy going, remove regulations, which will be helpful to business. And then also, of course, get the energy industry growing. And, the thing is, the energy industry is not going to grow unless they can get a good price. So this commentary from the Trump administration that, oh, we're going to get the price of gas half price from what it is now, that's not going to happen. Oil companies are not going to spend the money drilling if they're going to get the half the price. They're going to want to see another 20-30% higher price for them to increase their drilling in both the domestic U.S. and then and then also in Alaska. And of course, infrastructure changes by the government, allowing more U.S. LNG export opportunities and more projects getting approved. All of that will be the positives that will wake up the psychology, but also the pricing that I see improving in 2025, giving you the economic reason for companies to want to get out there and drill and grow their businesses.
Yeah, I find next year going to be so interesting to see what these drillers, what the companies do with what should be easier regulatory policy. But as not just you, but some other people have said too, rightfully so, if the price is lower, then why would these companies drill more? We will see, even if it is easier for them to drill. Let's touch on some of the stocks then. Let's start with the natural gas stocks because you even mentioned there a bit of a divergence in some of the performance depending on the location of where these companies operate. Are you seeing an opportunity then in the locations that are unloved right now that don't have access to some of these pipelines and shipping facilities as a better opportunity? Or do you stick with those stocks, those companies that are already hooked into the system and seem to be benefiting from it?
Well, I'm looking at companies and I'm saying that they're trading now at, close to 52-week lows. You've got Birchcliff, you look at Tourmaline. There's so many companies out there. New Vista's backed off here. There's so many companies that are bargains on the natural gas side. On the oil side, Surge, Varen, Obsidian are at 52-week lows. And if for those who are paying dividends like Surge, the dividend is only a low payout ratio. And so to me, there's no risk to it. Remember, while the price of oil is $70 and might go to 66, the Canadian dollar is now 143, 144, up from 138. So there's a lot more money going into the hands of the companies, and they're going to use it to pay down debt, to grow their businesses, maybe not this year, but 2025, but they'll be, keeping knocking off debt, pay their dividends and do enough capex to keep production flat. And then in 2025, in the second half, if I'm right about $90 oil, they're going to start wanting to grow 5 to 8% and then continue to pay down debt. And then NCIBs and dividends and special dividends will be things to look forward to. So Tourmaline, we know that they like paying specials. You saw Paramount announce today that they're going to pay out, $12 as a return of capital, $3 as a special dividend because of the sale that they did to Ovintiv. So again, they're going to pay 15 cents until they do that distribution. Then they're going to go to a 5-cent monthly dividend, so 60 cents. But by then the stock, if you're getting today, for example, Paramount's 29.08, if they give you $12, then your adjusted cost base becomes 17. And if you're getting a 60-cent dividend on $17, that's not bad. Plus, you've got then the growth story as Paramount drills up and brings on more of their liquids-rich natural gas in the years ahead. And remember, they're debt-free too. So you've got a fabulous balance sheet in the case of a Paramount.
So to your point about some of these stocks being at 52-week lows, there are also a number of stocks that are doing quite well. Paramount is one that has done pretty well, though it's been mostly sideways for this year. But when you look at something like Obsidian, then yes, it's sold off throughout the year and it is at lows for the year, but it's also well off of lows from a few years ago. So how do you balance out, again, that general rebound, the revaluation that we've seen in the sector from, let's say, 2020 over those next couple of years to now these stocks trying to find which direction is next, whether it's much, much higher or maybe drifting lower?
Well, you're going to have swings in the market as we always have, and we've talked about that before. But if you look at an Obsidian, the stock was trading as high as $12.37 in April when we had the high in oil in the mid 80s. It's reacting, of course, to the lower commodity price. It's $7.10 now, the 52-week low. The low in 2023 was 705, and the low in 2022 was 776. So we're sitting here at a very cheap price. And again, it's trading significantly below NAV and trading, 2 times or less cash flow. And the company is buying back stock with their NCIB fairly regularly, and they're growing their production. That's one thing that they have a standout as growing production in 24, and of course planning to do so even more in 2025. And people can just go to the website, for Obsidian Energy, look at the presentation on the website, see what they're talking about, look at their most recent news releases, and the balance sheet is getting better and better all the time as they pay down debt. And of course, they have a very active NCIB.
So, Joseph, when you're analyzing these companies, you threw out a number of different valuation metrics there: NAV, net asset value, cash flow. We can even look to free funds flow. We can look to their reserve base. Which ones do you focus on most to judge valuation against what a company is currently trading at?
Well, the first thing what I look at is the mix of assets and their netbacks and how profitable they're producing each barrel of oil. Second, I want to see insider ownership. I want to see them owning a lot of stocks so their money's in before ours. Then I want to look at price to cash flow. And then I want to look at net asset value on a PDP, proved, developed, producing, then a 1P proven, and then a 2P proven plus probable, and how much of a discount that is. And then I want to see that there's a growth profile in front of them. And then you want to see them, doing both NCIB and dividends. In the case of Obsidian, they're not doing the dividend side, but they're doing very actively on the NCIB. And so, it's got almost all the check marks there except for the dividend check mark. But again, the valuation is very cheap. They're big in the clear water, and they have a big business in a conventional oil play, light oil play. So the company's got 2 major drivers for it. And the key for them is the growth story, the growth wedge. And I think that, we have a target on Obsidian of $16 for a 12-month target. So at $7.10, that gives you a fabulous bargain. If we go to a surge, which I talked about doing, 26,000 BOEs a day, we have a $14 target. The stock trades, under $5, but it's also paying you a dividend, 52 cents, which is only a 17% cash flow payout. So you're getting yourself more than a 10% dividend yield paid monthly. So to me, that's a bargain. We've been adding to that name personally. And, between now and December 30th, I think we're going to be adding to it even more as the stupid season is on, where, like if you have big gains from telecom or technology, AI or whatever, you have those gains and you're going to be paying Ottawa check in April. So your view is, okay, even with the higher tax rate potentially in capital gains rate that Ottawa's putting through, the legislation hasn't passed yet. But the best thing to do is take a loss. So if a stock is trading at 5 or 480 or 470 or 460, and you pay $10, you trigger the loss. And so that's why we're seeing this almost meltdown in things like Obsidian, Varen, Surge, etc. And that's where you get the bargains. And taking advantage of these bargains, you could probably get a 10-20% bounce just into Q1 as the sales pressure comes off and as the companies report their results in February, March, between their reserve report in February and their quarterly results in March, the Q4 results in March.
Sounds like you're doing a little bottom fishing here, Joseph, or
I
at least
am. I
looking.
definitely am.
Yeah. When it comes to dividends, then, that is one thing the sector is great at doing, and that is returning capital to shareholders. Look, some of the dividends that you're saying, over 10%. How do we go about assessing just how stable these dividends are at lower commodity prices? How stable do you think they are? And what sort of research do we need to do when we're looking into companies to see, again, how stable these dividends can be?
Yeah, I think what you need to do is go to the company's presentations. Most of them show you what their payout ratio is. Some of them are high, like a white cap. But for example, today, Vermilion went through their results and they put an outlook for 2025. They raised their dividend, 3% from 48 cents, annually to 52 cents annually. So we're getting companies announcing, dividend increases as they give you their 2025 result, outlook, simply because they know their cash flows are growing. They know their debt loads are at positions where they want them and going lower. Some of them want to be under 1 times cash flow. Some of them want to be at half a year's debt to cash flow. And if they're there, then what they're doing is they're increasing their growth wedge, or they're increasing their dividend, or they're paying down debt faster. And I'm happy with all those levers being played.
So, Joseph, what about some of the smaller energy stocks? And they have broadly lagged the market. They can provide some of the best torque on the upside, but if you're bottom fishing, would you bother bottom fishing any of the juniors?
Well, it depends upon your time horizon and how entrepreneurial you are. There's a lot of stocks today, like Bonterra, which is one of my favorite names, and I'm an owner of shares. They're going to have flat production 25 or 24. They've got free cash flow generation at $70. They put out a press release this week, talking about their 2025 outlook. And to me, the stock is trading, ridiculously low compared to its valuation. I've got a $14 NAV. The stock's trading Bonterra today at 313. The low is 310, which is a 52-week low. And you've got a growth profile there. And as they knock down their debt, they're planning, of course, to start dividend payments. I think that they could get to their debt target in second half of 25 and start paying dividends at that point. So, they're 54% liquids, 46% natural gas, producing 15,000 BOEs a day. They're talking about being that same number next year, which generates free cash flow, as you'll find from that press release from the company. And then if they knock the debt down to their target, then they can start contemplating higher or putting on a dividend again. And if I'm right about $90 oil in Q4 of 25, they'll be knocking down debt fast, and they'll be able to start, putting on dividends. And also, they have a growth wedge with their Charlie Lake. They've got a growth wedge with their Montney. So between their Cardium, which is the base business, and those two growth wedges, and also, the ability to do an NCIB and pay dividends from Q4 25 on, I think that's going to be a driver, and that stock will be much higher at the end of next year than we see right now with the depressed conditions because of tax loss pressure, and also the fact that the sector is way out of favor.
Yeah, boy, oh boy, is it ever. We were noting how XLE, the energy sector ETF, was still doing quite well in these flat to down energy prices, but this has been a rough month, almost day after day of that moving straight down. Joseph, any other stocks that you want to bring to our attention that you see as set up well moving into 2025?
Yeah, I'd be looking at the companies that have access to the export market. So Tourmaline stands out as a buy. ARC might fit in there as well. And then you might want to start looking at companies in the service sector. Trican looks very cheap to me. As you know, we were a big fan of STEP, and it's being taken over by ARC. The vote is this afternoon. But I'd also be looking at smaller companies that have done transactions to grow. Rubelite, which is Sue Riddell Rose's company, is trading at $1.80 today. That's a penny off the 52-week low. The stock high for the year was 293, the low 179, trading at $1.80. And they've grown with the merger with Perpetual, and they're very big in the Clearwater with very lucrative assets there. So I think that's one that people should take a look at that's in the smaller capital side. Petrus is another one, pays a nice dividend. So there's a number of names you can go after, Pine Cliff. So, it just depends upon your risk tolerance and how big of a companies you want. I've got a mix of companies, between large cap and small cap that we own. And so I like to mix the ownership between the large cap and the, which I call conservative names. Then there's the growth companies and then the entrepreneurial ones. So Rubelite would be an entrepreneurial one, but a Tourmaline, of course, would be a conservative one. No debt, no net debt. And the company, is going to be growing nicely next year. 600,000 BOEs a day. They'll be benefiting from the export terminals, and their partner in the Rockies LNG and other projects. So I think that these stocks are trading. Tourmaline's right now trading at $60.61. The high for the year was 69.25, the low 53.45. I don't think we're going to see, I think maybe a buck or two down could be with more downside pressure, but I don't see it, going down much below that. And then as we talked about Paramount, 29.18 today, down 28 cents, low for the year 24.51, the high for the year 33.06. So it's right in the mid range there. But if they pay you a $12 dividend, which is a return of capital, and then a $3 special, and then they pay you dividends thereafter and grow the business, and pristine balance sheet with investments that are probably worth 500 million at least. It's quite something that they own a big piece of New Vista. It's very cheap, and I think people should be looking at these names. Both the largest caps to the smaller caps own something in the service sector. There's Total Energy, there's Trican, there's a number of companies that people can take a look at. And then on the royalty side, Freehold is trading really cheaply. They did that deal adding to their U.S. assets. They pay 9 cents a month, $1.08 dividend, per year. And the stock's, at a 52-week low today, trading at $12.34. And the low for the day was 12.29. And the low, prior to that was 12.38, and the high for the year 14.84. So if you can pick up a fabulous dividend, 9% yield, and get a buck or two of capital gain for conservative investors, Freehold stands out as a bargain.
All right, Joseph, thank you so much for sharing your thoughts on some of those stocks and giving us a heads up on some of those stocks. Always great having you on the show. Again, if you want more insights on any of these stocks, click that link in the show notes to visit the Schachter Energy Report website and learn more about Joseph's newsletters and investment letters. Joseph, thank you.
One last thing, Corey. We have a special right now for the Christmas holiday season. So if you're interested, just go to Ion Energy and you'll get the information there, or go to the website and take advantage of the holiday special.
Awesome. Joseph, great having you on the show. It's been a pleasure chatting with you all year. We're going to continue this in 2025. I look forward to hearing your next buy alerts for all these stocks because they have been timed quite nicely. Again, Josef Schachter, founder and editor of the Schachter Energy Report. Thanks for your time, Joseph.